The 10-year Treasury yield is the clearest rate signal in the mix, and the framework places it in a green momentum state when the yield holds above its recent trend threshold for several sessions. Here, the key watch point is whether yields continue pressing against the 4.45% level that appears in the conditional map. Yields matter because they compress equity valuations, raise discount rates, and press on credit and housing through financing costs. In our framework's reading of comparable periods, this roughly coincided with inflation momentum strengthening within the following few weeks in 9 of 11 similar instances. An observation under our methodology, not a forecast. The question it raises is straightforward. Does this level of rate pressure confirm a more persistent inflation problem, or does it fade back into a range that markets can absorb? What would challenge this read is a clear retreat back through the recent range and a loss of follow-through above that threshold. The labor signal is weaker. Non-farm payrolls, the monthly count of job gains, remain the key employment barometer, and the framework marks this area red when hiring momentum slows enough to signal deceleration rather than expansion. The latest reading still points to job creation that is virtually halted, which matters because labor is the backbone of household income and demand. In our framework's reading of comparable periods, this roughly coincided with softer growth confirmation over the following month in 7 of 9 similar instances. An observation under our methodology, not a forecast. The question here is whether slower hiring remains contained, or whether it broadens into weaker income growth and weaker demand. What would challenge the read is a re-acceleration in payroll gains, firmer labor force participation, or a renewed pickup in hours worked. Credit remains orderly, and that keeps the risk tone from breaking down further. High-yield credit spreads, which measure the extra yield investors demand to hold lower-rated corporate debt, sit in a yellow state when they are stable but not especially tight, signaling caution rather than stress. Credit matters because it is one of the cleanest readings of whether investors are demanding more compensation for taking balance sheet risk. In our framework's reading of comparable periods, this roughly coincided with a mixed equity tape and more selective sector leadership within the next several weeks in 6 of 10 similar instances, an observation under our methodology, not a forecast. The question it raises is whether financing conditions remain steady enough for risk assets to stay orderly. What would challenge the read is a fast widening in spreads, a weaker tone in funding markets, or sharper deterioration in corporate issuance demand. Energy is the commodity signal most tied to the current tension. West Texas Intermediate crude oil is the benchmark U.S. oil price, and its recent move keeps the framework in a red reading for inflation pressure when price action rises on geopolitical stress rather than demand strength. Energy matters because it feeds directly into transportation costs, headline inflation, and the broad cost structure for households and firms. In our framework's reading of comparable periods, this roughly coincided with firmer inflation readings and a more defensive market tone within the following month in 8 of 12 similar instances. An observation under our methodology, not a forecast. The question is whether the oil move remains a temporary shock or broadens into a wider inflation impulse. What would challenge the read is a sustained cooling in crude prices and a reversal in the recent energy impulse. The conditional map remains live on 2 thresholds. If the 10-year Treasury yield crosses 4.45% and holds for 5 consecutive sessions, in our framework's reading, inflation acceleration appeared in 9 of 11 comparable conditions, a historical characterization, not a forecast. That would sit inside a regime already defined by growth deceleration and would deepen the inflation side of the current reading. If the fear and greed reading drops below 15 and holds for 5 consecutive sessions, in our framework's reading, confirmation deteriorated in 7 of 9 comparable conditions. A historical characterization, not a forecast. That would matter because it would place more strain on an already moderate confirmation profile. The map is live. These conditions are being monitored daily across all 21 series.